Welcome to Looking at the Markets. I am bullish generally on stocks for the rest of this year and also silver. Now, there are no guarantees. I cannot guarantee that anything I'm saying here is true or accurate or will happen, but this is just how I feel. You have to make your own decisions, do your own due diligence, of course. Don't just listen to somebody in a video. But there's a lot of fear going around, and I'm not giving in to the fear. And let me show you a few reasons why. This is from Ryan Detrick on Twitter. Over the past 2 decades, stocks have bottomed around the middle of March. And March is working out perfectly according to the seasonal patterns over the past 20 years historically for the S&P 500. And there are no guarantees of what's going to happen in the future. I mean, this is just informational purposes only. I can't guarantee what's going to happen. But March, the first half, worked out perfectly according to the seasonal pattern, down, down, down. And now we're going into seasonally great rest of the year with some dips in there, but up and then chopping around, up, sideways, up, up, up for the rest of the year. Who knows what's going to happen, but if February is kind of rocky and choppy and March first half is rough, I mean, this is working out really according to the plan so far. So we'll see what happens. Now, this is from Charlie Bolello. Inflation has been coming down, and this is what the Federal Reserve wants to see so that they can have an excuse to tap the brakes on interest rate hikes. This is from Charlie Bolello at Charlie Bolello on Twitter. Overall, U.S. CPI moved down to 6% in February. That's the 8th consecutive decline year over year of inflation and the lowest level of the CPI since September of 2021. And the U.S. core CPI, which I'm sure the Fed is also watching, and this doesn't include food and energy in the equation, moved down to 5.5%. That's the 5th consecutive decline in the year-over-year U.S. core CPI rate and the lowest level since November of 2021. And so inflation is rolling over, and this is lagging. These indicators generally lag, and as you may be aware, the WTI crude per barrel oil price came down from $130 at its peak last year. It recently went below 70. So the oil price has almost been cut in half since its peak last year. And natural gas went down from $10 at the peak last year per MMBTU to less than $3, from $10 to like $2.50, something like that, recently. So if natural gas, which is where a lot of people's electricity comes from, if that's been cut by 75% and oil has been cut by nearly or around 50%, and home prices are down from the peak, and used car prices are down from the peak, things like that. Lumber came way down from the peak. It went up a lot, but then came down somewhat. So inflation has been coming down, and I believe this is lagging, and I expect inflation to continue coming down. No guarantees, but it's rolling over from being way too high. And so that could give the Federal Reserve and Jerome Powell, the Fed chair, an excuse to tap the brakes on interest rate hikes. Not necessarily this month, but at some point, I believe. And here's another inflation gauge that I'm sure the Fed is watching from Charlie Bolello. U.S. producer prices, PPI, increased 4.6% over the past year. That's the smallest increase since March of 2021, 2 years ago. PPI peaked at 11.7% in March of 2022. Think about that. The producer price index went from 11, almost 12% to 4.6%. That's extraordinary. I mean, this isn't even rolling over anymore. This is crashing. I mean, it's crashing from way, way high, but still. And this is from Ryan Detrick. Okay, so we have negative earnings growth. Does that mean you should get out of stocks? Well, it's up to you, but according to Ryan Detrick here, interesting note from NDR Research today, one of the best times for future returns on stocks is when earnings are weak, believe it or not. You don't have to believe that if you don't want to, but I mean, this is the data according to NDR Research and Ryan Detrick. Q4 earnings is down about 13% year over year That's the sweet spot for future returns on equities. At least it, historically speaking, has been, according to this tweet. It is when earnings are really good or really bad you need to worry, he says. And so that's what the data says. Are you going to follow your feelings? Are you going to follow what the crowds are doing? Or are you going to follow what the data says? And are you going to believe everything the Federal Reserve says? From Sven Henrik here, Northman Trader, on Twitter, I've never seen a Fed chair lose credibility with the market so quickly. From higher for longer, which Powell jawboned last week, you remember that when he was talking tough, right? Talking hawkish, to now the market believing in rate cuts coming in just 7 days. Stunning. Quite a difference. So you don't have to believe everything the Fed says from moment to moment, week to week, month to month, and you don't have to believe what the crowds are saying or interpreting the Fed to be saying. Because if you believe everything the Fed says, I mean, this is from Bespoke Invest on Twitter, Powell, you might recall this, said 75 basis points was off the table a month before he did 4 straight 75 basis point interest rate hikes. Think about that. Powell saying, essentially, 75 basis point interest rate hike off the table. And then a month later, starting 4 consecutive 75 basis point interest rate hikes. I mean, you don't have to believe everything that everybody says. I mean, the Fed also said inflation is transitory last year, and then before the year was over, he's saying inflation's not transitory. So just because Jerome Powell talked tough recently doesn't mean he's going to be tough necessarily. And silver, I am bullish on silver. This is from First Majestic Silver at FM Silver Corp. The gold to silver ratio is the most useful at its extremes. Like right now, gold to silver ratio 88 times, meaning per ounce, silver is 88 times cheaper than gold, or gold is 88 times more expensive than silver. When the ratio is topped 80, and it's around 88 now, it's signaled historically, no guarantees of the future, but historically it signaled a time when silver was cheap, inexpensive compared to gold. Historically, silver went on to rally 40%, 300%, and 400% the last 3 times this happened. I know that's not a huge sample size, so I want you to take everything I'm saying as just informational. You don't have to act on everything. But it's interesting. And so this is not the only reason I'm bullish on silver. If you believe that countries are going to move to vehicle electrification, then they're going to need certain commodities. And so you might have an opinion on those commodities, like I do. And silver is a very industrial metal. It's not just something people use for jewelry, although they use it for that as well. So I'm looking at silver for sure, and certain silver stocks. And I'm bullish on stocks in general. So if you want to panic sell everything because you're hearing about banking contagion, you could do what you want to do, but I'm doing what I want to do, and I'm feeling good about the stocks that I like right now. So be careful out there, be cautious, have an exit plan. Don't listen to anybody, only listen to yourself. And I will talk to you again very soon. Thank you very much.